Up in that top, in that notes box there, you see there's be able to pick this up later. Up in that top, in that notes box there, you see there's my email address. So if you have questions afterwards that you think of, you can just email me directly. And then that traderinsight.com results link is to go and look at the results of the core trading plan that I do every day. So let's get started. So this is focused today on what I call just first hour trading, right? What everybody would call first hour trading. But some of my strategies are going to have overlap into the latter part of the session, right? You can always just let them play out over the course of the day. But the majority of the stuff that we do right now, we are trading in the first hour, and then if we have anything else going on, we try to let the machine take care of it over the course of the day. And, when I say we, I am referring to my wife Julie and I. We have been trading partners since 1997, if you can believe that. So we've been doing this since we were both in graduate school, and we developed a bunch of strategies, and the strategies we're going to talk about today are sort of specific to the first hour of trading. One of them, the first one that I'm going to talk about, is called Fastball, and that one is one that you can use over the course of the session. You can actually handle it any way that you see fit. You can just trade it the first hour, or you can choose to trade it throughout the entire day. But our strategies were initially developed based on some really hardcore statistical stuff. We were both working on PhDs where we were looking at this data as a gold mine of, just information that we could take and manipulate and look at a bunch of different ways. And what wound up happening was we took a very complicated set of information and turned it into something that I wrote around a metaphor of baseball. So everything's going to have sort of this baseball analogy to it today, these patterns. If you don't like baseball, then when I'm talking about the fastball setup, you can just assume that is an expansion of range and volume, as opposed to being a strict baseball analogy. Keith, if you have echo, it looks like you're in there twice. It looks like you got into the room twice, and that's going to give you that echo. So if you just kill one of the windows that you have open, as you can see it says Keith 2, then the echo will go away. Somebody else had that problem the other day. Okay. So let's talk about this fastball setup, all right? This is the favorite of all the guys who have been to my income trading boot camps, all the guys I've trained over the years. Fastball is the pattern that they look for with the highest hopes, even though it's, the outcomes for fastball are pretty similar to the outcomes for everything else on the trading plans, but fastball is definitely the quickest way to get your money first thing in the morning. This is an expansion of range and volume setup. And what fastball is looking for is a day that you have the widest range of the past 10 trading days, so 2 weeks worth of data, right? The volume, you want the volume to be higher than the average volume over the past 2 weeks. And then we're going to look at the short side for the example here, for the ideal example, but just know that the long is just the inverse of this, right? But in this case, we want to see a move lower, and we want to see it close down in the 25% part of the bar. Okay, so 25%, you want to see a stock that opens high, closes low, essentially. And then the short sale is going to be the following day, 10 cents below that expansion day low. So it's a pretty simple set of criteria. The finesse here is that you're going to go to a daily chart and find support, right? And sometimes drawing those lines to find support and resistance isn't as easy for people as they think it should be, but with enough practice, and if you just keep working at it, you'll see that you can apply the kinds of principles that I use here and find yourself some pretty good trading candidates. The intraday chart I use to find a stop loss. So I look for a target on the longer time compression, and I look for my stop losses intraday in the same time frame that I'm going to be trading. And this pattern, if you look at the pie charts up here, so this is the way that I keep records about the trading. So when you go to the results at Trader Insight, you can go back, you can see every single trade all the way back to 2006. And all my trades are published tonight for tomorrow. And this set of results is only for the first part of the trading plan. So I know a bunch of you are going to be looking at these trading plans over the next couple of weeks. And what I want you to focus on is only the portion of the trading plan called Around the Horn is represented in the results. And the reason for that is that's the most replicable part of the trading plan, right? You should be able to automate that and, just be able to replicate what the plan itself is doing in terms of performance. And here is sort of what you need to look at when you look at these results. You can see the pattern distributions, right? So pattern distribution, that first box, I'm keeping track of how many times I found a pattern, triggered pattern distribution. I'm looking at how many times that pattern actually triggered during a trading day. So what this allows me to do is look at the first pie chart and say, did I cherry pick patterns, right? Was I looking for things maybe that weren't there in terms of what triggered? Because if that fastball would be a giant portion of the pie, and then in the second one in the triggered patterns it was not, then that tells me I'm looking for something just because I like trading it. And we want to look for it because it's objective, right? So we want to make sure we're getting into trades because they're actually the best opportunities, not just because we like them. Longs to shorts, you can see this year we have been mostly short. We have got, pretty much a, love them or hate them, we've got a chaotic situation going on in Washington, and that's caused a lot of the opportunity to shift to the short side. That's okay, right? We don't care as long as that bar chart down below there looks about the same as that long to short ratio, right? That we're not getting most of our gains out of the long side of the market when we're trying to go short all the time. That tells us, again, we're not introducing any kind of bias. We're not trading what we think. We're actually trading what's there. And then you can see your winners to losers. That green stripe there is a scratch stop. That's a money management stop. And then you can see the overall pattern profitability. So you can see that the portions of the pie, as they're represented in terms of the triggered pattern distribution, are really well represented in the pattern profitability. And all that stuff, then tells you how you can go through and expect things to play out over time. So as long as you're not introducing bias, you wind up seeing a really good set of results with these strategies. You can see in 2017 year to date, this is up about 87.5% across all the trades, assuming a $100,000 account, and you're fully leveraged on your trades, which I always think is the only reason to have money on a trading account is to use it, right? It's your tool. So for me, if I've got the money there, I'm going to put it to work. And I'm going to tell you that it's going to look pretty good going into the end of the year, because the last best performance that we had was in 2008, and that was an 88% return, and we are creeping up on that right now. So with all that in mind, right, we see fastball pattern we just were talking about is the big leader this year. Let's look at how the short sale sets up. So here's the way that you want to see this in an idealized example. These are daily bars. Okay, and on the daily chart, we get a downtrend, we get a pullback to the upside, and then we get this big daily bar, right? Widest bar of the past 10 sessions, preferably on big volume. So the way that I'm going to set up my plan is I'm going to say 10 cents below the low of the daily bar that created the pattern, I'm going to sell the stock short, and then I'm going to target daily support, or daily resistance, daily support, wherever the stock bounced back, on the chart. Or I'm going to use things like measured moves and Fibonacci expansions, if something's making a new low or making a new high on the long side of this trade. So Tom had asked about good support and resistance for this. Anything that identifies where prices tend to cluster in the longer time compression is going to be great for finding your targets with this. So what you're really trying to do is, that's an institutional move, right? The expansion of range and volume is an institution comes in, starts selling stock, and the stock keeps selling off over the course of the session because it never finds demand, right? So supply is just overwhelming demand. And what you're trying to find when you're looking for support, right, when you're seeing the place on the chart that it bounced previously, you're trying to find liquidity. You're trying to find pools of demand that are going to stop this move lower. And it's been my experience, when we pick a target based on support and resistance, we wind up being pretty close to, dead on accurate as far as where it's going to bounce for the day, right? Because these are intraday trades, so we're not looking for what's it going to do over the course of the next month. We're looking for what's it going to do tomorrow, and tomorrow is pretty well represented when you look at a daily chart and just try to find the prior bounces, the prior hiccups. So let's look at how I set one of these up. Got a couple examples. The first one is from a recent trading plan. This is PBH, right? So you have Prestige Brands. And you can see it here. It just should really jump out at you when you look at a chart that you are seeing the widest range, right, of the past 10 sessions. You've got a very significant volume expansion. For those of you who aren't familiar with this particular charting package, so this is Realtek, is the charting package that I use. The volume on the bottom is volume by day, and the volume on the side is volume by price. So that's just the way that I like to look at my data. If you have those pieces of the puzzle in place, then the next confirmation that you want to look for is on your intraday chart. So now we know it made a big move to the downside, and really what we want to see is that move was persistent over the course of the day. So in this case, we see the big trend lower, then we saw it try to climb a little bit higher, and then there was selling pressure going into the close. And we also see very heavy volume into the close. So that's telling us that they couldn't get it done coming down through here, right? So as this move was being made, they couldn't get all the selling done that they wanted to get done. And then they waited for the stock to come back, and they started selling it again at this overhead support and resistance area. And again, it just started moving lower going into the close, and then right here was the big closing move, and that's always sort of a telltale sign that we're looking for, is that move going right into the closing bell. So from this intraday chart then, since this one moved to a new low, remember I was talking about measured moves, there is no support and resistance below this on the daily chart. So on the intraday chart, what I like to do is bracket up ranges. So this is pretty similar to the stuff we're going to look at with Scalper a little bit later with my NASDAQ scalp strategies. But you can see that we've got this significant move that sort of wraps up what the stock did in terms of downside from a consolidation. So we had a consolidation range that formed. Let me just grab a pen. And, all right, you had this consolidation. And then you had the move to the downside where we then saw the next consolidation. And the magnitude of that move is what I'm interested in. So I'm going to take the measured move, and I'm going to then project it down into where I think it's going to go tomorrow. So the measured moves are a really good tool, especially if you don't get into the bad habit of over measuring, where you're going up and taking the bigger slide to the downside and saying this is what I want to see happen tomorrow, because really the market doesn't care what you want to see happen. The market's pretty predictable, and those measured moves, if you look at the waves that occur over the course of the day, you can get a good expectation for what's going to happen the following day. And then another little trick is if you overlay a fib expansion on it. In this case, we see that on the bigger move, we've got a 1.618 expansion right about the same place that I'm looking at a target. So I've got a pretty good idea of how I'm going to set up my trading plan at this point. And those of you who are going to, try this thing out for the next couple of weeks, kick the tires, you're going to get this every night for the following day. And what it has is some very, very precise levels that we're going to look at in terms of how we're going to trade this thing. Over on the left side, you can see that we have the position identified as a short. Our entry is 43.13, right? That was 10 cents below the low of the bar that's creating the setup. So on the expansion of range and volume, 43.23 was the low. We're getting in 10 cents below that, 43.13. The stop was from support and resistance on the intraday chart, $43.42. Initial target was $42.51. That was our extension. And the ratio on this one, 2.14 to 1. So we know we stand to make $2.14 for every dollar that we potentially lose. And here you see 50% of the distance of the target is $42.82. And the way that my plan works is when you get 50% of the distance to the profit target, you move your stop to break even. When you get 10 cents to the profit target, you move your stop to that 50% level. So I'm not exactly sure why, but a lot of people find that incredibly confusing. I think it's a pretty simple set of rules to apply, but once you're in, as you can see here, it's very easy then to automate how this thing plays out over the course of the day. In this case, we see that the planned entry was hit about mid-session. So in this case, all we did was, in the first hour of trading, set up a conditional order. That conditional order said, if we get down to that planned entry price, get short. A subsequent set of conditional orders are set up as OCOs, and those just say, if we move up to the stop loss, get out at the stop loss. If we get down to the target, get out at the target. And obviously, in this case, we had a full target on the move. This was just a couple days ago. So that's the sort of textbook way to get into one of these trades. This is a support and resistance timing version of this whole thing. So there's ways to expand on what we're doing with the fastball setup. And this is particularly pertinent in the first hour of the trading day, because this is where you're going to have to go and intervene a little bit. We see this one qualified, had a wide range bar, not a giant bar, but it was the widest range of the past 10 sessions. It happened on a volume expansion. We can see there is prior support and resistance up above. That's where we're going to put our target. You see those highs, those lows, those opens, closes. Everywhere that stuff overlaps is where I'm looking to pull the plug on this thing if it gets there. Because if it gets back into the prior support and resistance, so if we get back up into here, I'm expecting that it's going to hit this volume and it's going to move lower again. So I don't want to be part of that. When I get up into the profit target, I just want to exit my position. So for me, it's pretty easy to go back and just eyeball where these things happen. And I think with a little bit of practice, it's pretty easy for everybody, really. But that's how we're going to set this one up. And then on an intraday chart, I'm just looking for, if I'm wrong and this doesn't wind up moving in my favor, where do I want to get out of the trade? When I'm looking for the support and resistance area, first thing I want to see is where was that buying pressure going into the close? That tells me this is where something happened. This is where the institution came back and decided to pick up more of this stock. And then where was the spot that price began to move back in the opposite direction? And in this case, you got a very tight stop because you can see that when it made that, what I call a double header move up at the top, you had a big bar up, you had a big bar down, and then it started moving down a little bit into the close. Well, if that happens again tomorrow, then what I don't want to do is be part of a move that gets me all the way back down into here. So I'm going to put my stop right up where that prior support and resistance line is that we just saw draw there. Nice volume going into the close. All the pieces of the puzzle are in place. So I put my plan together. And again, all the components of my trading plan are in place. I know that I'm going to go long $62.85. That's 10 cents above the high of the prior day's session. My stop from the 5-minute chart, 62.56. Initial target, 63.26. That's from the daily chart. Stand to make $1.41 for every dollar that I stand to lose, and 50% of the distance to the target is 63.06. When it goes to 63.06, I'm going to move my stop to break even. Now we also see that I've got these support and resistance areas identified over here. So think back to the chart, and when you're going to get to these levels, 62.55, 62.40, and 62.30, I'm expecting to see some propensity for a bounce, right? I'm expecting to see price bounce there again. So these are just levels that I identified when I was looking at it as here's support, here's support, here's support. When one of those overlaps with a pivot, in this case $62.32, then my guys and I are very, very interested in taking an early position if we can get one. So we want to get into the stock early with a very tight stop. In this case, this would be early in the session usually, and if we get in on a 62.32 bounce, we're going to have a stop loss down below that, probably at 62.22. So it's going to be a very, very tight move, and we're just going to try and see if we can get some extra profitability. So when this one played out, you can see our planned entry was all the way up here, and our stop loss down under that trading range from the prior session, and our target is up here. So we can see that the planned entry led to a move to the profit target, no problem. What we also see, though, is we had this move right off the open down to that prior resistance, prior central pivot confluence area that we identified. And usually when we're in the room, you're going to see that as well, right? If you come in and you join us for a couple weeks to see what you think of this stuff. In the first hour trading pit, you'll see the guys are talking to each other about we're coming into a confluence zone, we're coming into a prior support and resistance. So here we have the opportunity, once it gets down below, to catch the bounce coming back up through it. And what that does for us is gives us an additional 53 cents in profitability, because the bounce goes from that central pivot all the way up to the planned entry price, right? That's 53 cents. So we turned a 41-cent profitability into a 53%, or I'm sorry, into a 94-cent profitability. So you can see it really adds a lot to the bottom line to watch these things in the first hour. It's nice to set them and forget them. It's nice to just load them up and have them trade out over the course of the day. But it's also very nice to stay frosty and get in there first thing and watch these setups develop and see if we can't get some extra profitability. So next thing I'm going to get into is trading gaps. Does anybody have any questions about the expansion of range and volume setup before I move on? Not usually a ton of questions in these things, but I want to make sure that if something wasn't clear for someone, that we can go back and have a look at it. All right. So that was fastball. So again, fastball picked because it looks to me like a fastball pitch, right? It's coming in really hard. It's very volatile. That volume, to me, it just looks just like the kind of thing I like to see my Dodgers do. So the next one is a gap trade. And this is the second most popular trade in terms of what my folks who have been through the boot camp like to do. A couple of them in particular will just look at this trade because they only want to trade the first 20 minutes to half hour. So you'll see that as well. This is an opening trade. This is going to occupy your time right around the opening bell. And I'm going to show you some math here, and just don't think twice about it, because your software will find this for you, but I think it's important that you just know how this thing functions before you go trading it. So I call this one Baltimore Chop. It's an opening gap reversal. Baltimore Chop was a trick that the Baltimore Orioles used. They had some guys who were lousy base runners. And what you would do is, instead of bunting the ball, you would smack the ball down into the ground, bounce it over the pitcher's head, and that would give the slow runner a chance to get to first base before the ball could be fielded. And you're going to see in 2 seconds why I call this Baltimore chop in terms of a pattern, because that's just exactly what it looks like to me when you get these big gaps. If you're going to try and plug these numbers in yourself, you can do it a bunch of ways. You can use the implied volatility of the front month contract to develop a statistic for what's an acceptable gap or what's a significant gap, or you can use range and true range, which is what we've come to, because it's a lot easier than going through and pulling all that options data. Really what you're going to focus on is true range. Range, for anybody who's new to this, the range of a stock for today is just the high minus the low. So if today's high is at this level and today's low is down here, and the high was $50.10 and the low was $49.40, then the range is 70 cents for the day, right? Everybody who's ever looked at a stock chart knows how to calculate that value. True range is a little bit different. So what we're interested in assessing are gaps. So we're interested in figuring out whether a gap is statistically significant, and if it is, then we want to apply this pattern criteria to it. True range includes gaps. So it's always best when you're doing a statistic to actually measure the thing that's of interest to you. And the true range is going to be the larger value of either range or the absolute value of today's high minus yesterday's close, or today's low minus yesterday's close. In other words, it includes any kind of a gap value between the closing price and today's price in determining whether or not the range is significant. So look, we've got in this bar, you've got the high, the prior session, you've got the close, and when you subtract those two values, now you've got a $50.10 high, a $49 close, you got $1.10 true range for that session. That's the number that we're interested in. So there's a couple assumptions in this model. One is that it's a normal distribution because we're going to apply a statistic to it. If you're using TradeStation, you're Realtek, Metastock, any of those packages are going to be able to calculate all this stuff for you. We're looking at true range as a proxy for volatility. We're assuming that volatility is mean reverting. I've written a bunch of stuff over the years on that. I can tell you volatility is definitely mean reverting. And what all that gives you is access to this thing. And this is the standard normal distribution. If you have a gap that goes out into those two red zones, right, a gap up or a gap down, that's one standard deviation away from the average true range. That gives you 68.2% confidence that you're going to have a move back towards your average. If you move out into that blue zone, you've got a 95.44% confidence level that you're going to move back towards the average. And if it moves out to the 3 standard deviation area in the green, then you've got a 99.72% probability. I'm interested in that 2 standard deviation move, 95.44%. And what we're looking for, as I said, is a reversion to the average. And all a mean reversion means is you've got some data. In the middle, you've got that black line. That's price data. That's your average true range right in there. And then you've got periods of high volatility, those red balloons, and you've got periods of mean reversion where you're moving back towards that mean. Not necessarily true that you're going to close a gap, just you're going to move back towards it. And that's what we're interested in capitalizing on. Really simple calculation. What your software is going to do is take 10 days worth of true range data, and it's just going to plug it into a simple standard deviation formula. We're going to use n as the denominator. If any of you guys are engineers and you're going to give me trouble here, it's not n minus 1. The sample set is, in this case, dictates that we just use 10. We're using 10 days worth of data. We plug this in. So for each one of these, we're going to subtract the average from the value. We're going to square that to get rid of a negative number. We're going to divide it by the number of observations, right, 10, and then we're going to take the square root to get rid of the square. And what all of this is going to give us then is a standard deviation in this case of 49 cents. That's one standard deviation. We multiply that by 2, 98 cents, that's 2 standard deviations. You add it to your average, that's how much you have to gap. So you add that 98 cents to the $1.25, and that tells you how much you have to gap the next day in order for this to be a mean reverting trade. And the pattern on this one looks like very much like that baseball getting spiked into the ground. These are 5-minute bars. So the prior session, you have a move up into the close, and then we get this 2 standard deviation gap to the downside. Assume that it met the criteria. And for every subsequent bar, so you could trade this as a fade off the first bar, but the favorite way that I have of trading this is we wait for a second bar to form. This is how you start filtering out which ones are the good ones from the ones that are just a little bit too aggressive. By the time you get down to this bar, you've had a series of lower highs. Each one of those lower highs was a place that you would consider entering the trade. So when the stock first starts moving down, in the first bar, your entry level would be up here. In the second bar, your entry level would be above that high. In the third bar, the entry level would be above that high. But we just keep adjusting our bracket lower. This is just a simple bracket order that we put out. And the bracket says, get me in above the high. When the next bar moves lower, we change the bracket, get me in above the next high. And finally, we have the lowest bar. You don't know it's the lowest until it actually forms. And this one is going to trigger you in the next bar. And what we're going to do is target something significant that happened early in the session. So usually we're targeting the open or the high. We use that volume by price data pretty extensively to figure out where that target should be. But this is the way this trade is structured. And really, it's been our experience over the last 20 years. The deeper those bars go, the better off you are. And we only trade them for the first half hour of the session. So this is for the first 30 minutes. So the first thing that we're looking at during the day is which one of these gaps go. That fastball trade is set up. We're looking for where are the inflections? Is there an early entry? And when we couple it with this strategy, we've got our hands pretty full right off the bell. And you can see there why I called that Baltimore chop, right? So that's to me what that looks like. That ball spiking down to the ground and then bouncing. Here is one that happened today. So this was COTY. If you were in the room this morning, you saw Rick trade this. I was busy trying to capture charts and things for today, keep this thing pertinent and get some relevant examples in. So COTY, this was a short entry on earnings news. So here's the stock. That's the other thing I should have mentioned. We want to trade these on primarily earnings news. Some surprises that happen business-wise are okay because it's just a normal business thing. Other things are not okay. So if there's a fundamental change in the way that the company is structured or something, you don't want to do the fade on it. What you want to look for is just your typical news, your earnings, something went wrong technologically. You want to stay away from CEO is being removed or the chief operating officer is going to jail or something like that. Those are things that can really skew these things. But as long as you stick to run-of-the-mill news, you're usually off to a good start. This one gapped higher this morning, and it did so on earnings. This is from Fly on the Wall. So Fly on the Wall reported at 6:30 in the morning Eastern Time that COTY reported Q1 adjusted EPS of 10 versus 7 and 2.24 versus 2.24, so it's in line on revenue. And that was enough to give us a pop first thing in the morning. And you can see here that it's pretty textbook in the terms of the way that this played out. Rick did this one live in the room. So he was trading this with his money and showing everybody what he was doing. Your entry level at the time that the second bar forms is right there. So right below the low of the second bar is where you would plan your entry. And your initial target would be right at that opening tick. So you can see the opening tick is also the low. And if you look over on the right side of the chart, there's significant volume there. There's a reason that price bounced there. There's heavy demand for it there. If it comes back down there again, we expect that that's where it's going to bounce again. Now, in this case, there's a problem with this trade because the place that I would put the stop loss would be above the high of the entry bar, or above the high of the bar that creates the entry. And if you look at the distance from the entry to the stop versus the entry to the target, you can just see right off the bat your stop is wider than your anticipated profit on this thing. So I'm going to wait, and that's part of it. If that thing would trigger on the next bar, I would not take that trade because I just don't see the ability to have a proper reward to risk ratio in place. But a few minutes later, our entry level changes because the pullback got deeper. We never had a violation of that prior low, and now we've got a stop that makes sense in terms of the level of profitability. And of course, you can see what happened. We had a beautiful move on a relatively low price stock, 17 bucks or 18 bucks or whatever this is, and you had this move that got you then from your entry price at $17.55 all the way down to $16.86. That is a very nice way to spend the first half hour of the trading session. Here's another one. This is AutoNation. This is a short on earnings news, and this is a little bit different in terms of how it plays out. I want to point this out to you as well so that you know what you're looking for when you're setting these up. You see the gap, obviously, and we know that it was on a revenue beat, so we had good earnings. Consensus was actually a little bit higher on this one, still gapped higher, but what we see happen during the session is a little bit off. So if you look at that first bar of trading, where's the volume? Volume is up sort of in the top part of the bar. You can tell that by looking at the green volume by price data out on the right side of the chart. So if the entry is going to be on a violation of this bar, which is the deepest bar in the pullback, and then the stop we're going to put right up above the high of that first bar of trading. I'm doing that because that's where the price really took off. Right? If it gets back up above that price level, I'm expecting that I'm going to see another significant push to the upside. That's not something I'm interested in being a part of. But my target is going to be where all this volume was. So in this case, we don't have that giant target range that we would see from looking at the low of the bar or the open of the bar, because that could have been a stray tick or that could have been an ARCA print. What we're looking for here is the move from $53.54 down to $52.75. And if it goes further, if it goes all the way down to the bottom of that first bar's tail, well then, great, but I'm not going to be part of it because I'm going to be out of that trade on my bracket order based on where the volume was. And we did this one live in the room last week too, so everybody who's here from my Trader Insight bunch and the boot camps and such, this was an anomaly in terms of how it played out. And the reason that we set that stop level or that target level right there is because there was just no volume down low in the bar. And what using volume by price this way allows you to do is you don't have to go back and dig through the tape to see where something happened. You can just take a quick look at the side of the chart and you know exactly where you're going to run into support, and look how well that supported right at our exit that day. Now let's do one more. This is an entry on news. So this one's a little bit different. In this case, Equifax. So this is a little bit of an older example. This goes back a few weeks more, but I wanted to show it just because the behavior here is textbook, even though the news wasn't earnings, and you just have to differentiate when is it important and when is it critical. So important news like this, it had a big breach. They lost millions of people's data, and the stock moved lower. So you can take a quick look at Fly on the Wall, and you can see exactly that it's down 14.5% after announcing the cybersecurity incident that potentially affects 143 million U.S. consumers. It's still not going to fundamentally change the way that the company does business. So you've got perhaps higher security costs coming up down the road, but it's not something that implies that the company's about to go under or something. So when we see this one open, it's a much higher dollar stock. So we have to go and make sure that the profit and loss parameters are going to be acceptable in our account, right? So that's going to be the first thing that you need to consider is you're going to get in on this violation of the second bar. And your initial target is going to be up at the morning's high because that's where the stock bounced lower previously. You can see we missed a couple dollars or $1 in profitability by setting our target there, but we don't care because this whole thing is the business of figuring out where the statistic starts to fall apart. If it gets up to that level that it bounced from, we're expecting it's gonna bounce back down into the gap. And the thing to consider here is $122 or $121 per share at the time of the entry. How many shares are you going to trade? Because what you don't want to do is start moving this stop around. So you've got $119.94 very logical stop, and that's based on after we found an entry, the very next bar opened, dipped lower, and found a bounce. If that $119.94, if a dollar stop feels like it's too much, then what you need to do is roll back the number of shares you trade. Don't take 1,000 shares of something if the thought of $1,000 stop out is going to make you sick. Take 100 shares, take 200 shares. Always adjust your share size instead of your stop magnitude, because if you determine you're only willing to lose $250, so you move the stop up, that's going to be trading suicide because the market doesn't care how much you're willing to lose. The market cares about where support and resistance is. And, that's a lesson that most people learn the hard way, but I think it's worth pointing out that it's one of the easiest things to solve in trading. Just adjust your share size, and then you can feel comfortable taking the trade and letting the trade play out according to your discipline. And then you don't start that war between your ears of, boy, I really blew it, and I'm not a good trader, and you start having all sorts of fears and doubts about what you're doing, and before you know, you're out of business. This will keep you in business. So any questions about Baltimore Chop? Any questions about statistic or anything to do with that setup? I think it's much more straightforward than it appears at first glance. You're not doing all that math. Your software is doing it, but I really have a beef with indicators and trading techniques that are just out there and people use them and they don't understand what they're doing. I think knowing what's behind your decision making, these are all decision support tools, and knowing what's behind that support is very, very important in having the courage of your convictions when you actually go and trade these things. So, all right, no questions. I'm doing a fantastic job, I guess. Fantastic. The NASDAQ Scalper setups, this is another set of trades that we use primarily in the first hour of the trading day. We love this one. I see Matthew's in here. Matthew sort of specializes in this. He likes this quite a bit. This is one that people either gravitate to or are pushed away from because they don't like the decision-making process. But I'm going to show you what it is. It's a very simple set of decisions that you're going to make when you look at these stocks in terms of what your expectancy is and whether or not you're going to take a position. So what I want to do when I set up my scalper trading plan, I want to find super caps. And when I'm looking for a super cap stock, I'm looking for the Apples of the world. I'm looking for things that do 5 million, 10 million, 20 million shares a day. And some of you might be thinking, well, those stocks don't move. So why would you focus on those for a day trading strategy? Well, the reason is that they get range bound, and those range bound situations are very tradable. What you want to make certain is that when a super cap that you're looking at tends to start trading inside some volatility bands over the course of the session, that those bands are at least 20 cents apart. 20 cents I find is a real good range to use. When we have tight travel ranges, the next thing we want to be certain of is that there's good liquidity. So the way to find good liquidity is to make sure you have tight spreads. Sorry about that, I had a cough. So Apple tends to trade in these 1 penny ranges. And for the opening trades, for the ones that we do right at the opening bell, we want to make sure that the pre-market liquidity was very, very high. So Apple tends to trade in the pre-market the way that other stocks trade during the day. That gives us a lot of confidence that we're not going to get taken out of a spread, that the spread's not going to eat up our profits, right? So once these pieces of the puzzle are in place, we're ready to start looking for the trades. Give me 1 second. I don't want to deafen anybody coughing. So what we're looking for on the intraday chart, so I do Apple, I do Netflix, I even do Tesla. So again, I just change the share size when I'm doing Tesla. I'm not crazy. I'm not doing 1,000 shares of Tesla. But you look for these volatility bands, and what you want to really focus your attention on is the most recent activity first. So you can see this would be the daily chart for a current day, and you're planning your setups for tomorrow. And you see that they form sort of later in the trading session. You've got these bands set up that are 20 cents apart, and you can see Apple traveling down through them. So in this case, we have a move from here down into here, and then we see a move from here down into here, and then we see another set of moves from here down to here, and we see that the price is bouncing around inside those ranges. That's what I'm looking for. So I want to see that price is trading in a constrained range, and that once it gets into that range, it tends to be volatile within the range. And I'm going to set up a trading plan for that exactly the same way that I set up my around the horn plan. I've got a very high level of specificity. I know that I've got an entry at that top band. I've got a scalp that I'm looking for down to the next band, and then I'm going all the way down to the bottom band. So when I put my plan together, I want to spell out what my opening bias has got to be. So in this case, the stock was moving lower. I'm going to have a bias to the downside for the open the following day. I always try to have more than one on the plan, and you want to be very, very mindful of the relationship of those bands that you're setting up there in relation to the floor trader pivots, because sometimes the pivots can get in the way, and if the floor trader pivot is close to where your entry is, or it's between your entry and your profit target, then you've got a high likelihood you're going to have a bounce in there. So we set up to do our trades right at the opening bell. So in Apple, what I do is I look at the pre-market data. I see how close is it trading to one of my bands. If it's been trading lower, and then continues to move down through that band, I'm going to get taken into it right into the open. And usually, what those wind up doing is generating a nice profit right off the open. Hi, Max. Yes, you will receive. Everybody's going to receive the link to the recording of this. So no worries. And if you have questions, you just send me an email, adrian@traderinsight.com. And you guys can even, let me just pop this up here very quickly. 310-804-2248. That's my cell number if you guys think of any kind of questions after we're done here, because these webinars, people tend to not ask too many questions. But if you think of something later and it's something you want to answer right away, send me a text and just tell me you'd like to talk, and I'll send you back something saying, hey, I'll be free in 10 minutes. We can we can talk then, or whatever. So let's get back to this. So we've got the plan, right? We've got our plan set up, and then the following day, what we're going to do is we've got these things plotted on our chart, and we wait to see if we get tests of those individual lines. So we've got these shallow moves up above the volatility band, and here we see Apple open below the top level band, made a move up, a little poke up through there, and then the 161, or that the higher band up here, right? We had nice tight elasticity right around the 159 or 156.87 line. It reversed back down, came back down to 156.54. That's our first target. Went back up above that, came back down through, got down to the 156.30 target. And that is, in the first hour of trading, we use that thing very, very frequently for just bracketing these things up. We get in, we focus on where we think it's going to go. We bracket the orders, we set them loose, right? You just set them up to go on their own. And over the course of the session, right, we see that those bands expand. So as you get later into the trading day, if you want to trade these after the noon recess there in New York, you can add the additional trades just by setting up more volatility bands. But in this case, right, as a first-hour trade, I find it's got the most power, and it's probably the best setup, and it's definitely a favorite for us. So we love this one. The guys love it. I think those three setups are enough to get you really, really focused and get you understanding what it is that you're going to be looking at when you get access to the trading plans and the first-hour trading pit and everything. So at the Traders Expo, we just finished. We had an offer for those guys. I'm just going to give you the essentially the same deal. You don't have to buy anything. You can just come in and have a look. So if you do decide that you want to be a member after a trial, you receive a 20% incentive over the life of the subscription. We're just going to give you 20% off of the subscription prices. In this case, I'm just going to permission you in, so you're not going to have to tell us you want to get a refund. I'm just going to give everybody a 10-day pass to come in and look at what's going on. And if you do wind up buying any one of these trading plan subscriptions, then what you can do is apply that to an income trading boot camp coaching program, a mastermind group, which is sort of our ultimate training. That's, we spend a week with you, and you spend a whole week of doing online stuff before you ever get there. So you have to make it through a 650-page manual and a whole week of online training, and then you come for another 4 days of working with us in person. And it's a really good experience, and the guys love it. Everybody who's been has really thought it was great, and I hope, if you want to elevate your trading, and if you're thinking about it, I hope you'll give us consideration, especially after you see what's going on with the trades. So you're going to get a set of trading plans every day. You'll have access for the next couple weeks to the Around the Horn plan and to that Scalper plan, and you'll also have access to the first-hour trading pit. If you feel like you need a little bit more time to evaluate it, you just let us know, and we'll give you some extra time. Some of the guys in here know all about that. Couldn't get in, couldn't focus on it as much as they wanted to, and we've got no problem making sure that everything is a good fit for everybody who does it. So there you have it. That is an hour of talking to me about the first hour, and I'd love to know if anybody has questions about what we just talked about. If you do, type them into the chat there. We've got as much time as you guys need if you have questions, and if you don't, then you can always send me an email or call me. It's great. Take advantage of it. So the trades are taken in the room, and the results are going to be for the planned trades. So most of the guys in the room are focused on the trading plan, that's for sure. And then we also have those Baltimore chop trades in there. The reason we don't record results for that kind of a thing is it's subjective. So we do put out every day a set of results for what happened that day in the room. Okay, here's this trade triggered, this trade triggered, and show what the result was. But the hard results, the stuff that is presented in the spreadsheets, that's every trade that triggered from the plan since 2006. And yet, we're going to email you we will email you the trial link. So you'll get a username and password will be generated. It's just going to send you everything to come in and have a look every day. Every night you're going to receive the 2 trading plans. You get a link to those. Just sends you an email every day saying your trading plan is ready. And then you just click on the link for the trading plan and you download it. And then it also has the link for here's how you get into the room in the morning, and then you come in and you trade them live with us. So it's most people who do it feel it's a very good experience, and we really limit. You'll see that there's reasons for us to limit the number of people who are on the plans. It's about liquidity. I have to think about I can't have hundreds of people trading these plans because if you did, the liquidity would be affected, and it would be hard for the guys who've been to boot camp and the guys who've been subscribing to this thing for years to get in front of the opportunity. So we restrict that, but it's usually not a problem. Most people sort of self-select in terms of what they want to do anyways, and we never have more than probably 60 or 70 people on the trading plan. So you'll see. It's going to be fun, and I hope you guys take us up on it. We'd love to see you. So if there's no other questions, I think we're done. I want to thank everybody for taking time out of their day for this webinar and for coming today. And then if you're watching the replay, which is the case for most people usually, also feel free to call me, same as if you were here with questions. And again, the email, in case it's not on the replay, is Adrian, A-D-R-I-A-N, @TraderInsights.com. Happy to answer your questions. All right, you guys, have a great day.